Now, I'll be talking about Warner Bros. Discovery's $9.1 billion goodwill impairment in mid-2024, which offers a clear example of what's called a big bang strategy. This write-down came just 2 years after the $43 billion merger between Warner Media and Discovery, which created over $22 billion in goodwill. So what is goodwill? It is usually a very large income statement expense and asset value decrease, reflecting a total or partial loss of a company's past investment in business acquisitions. The impairment was triggered by two major developments. Warner Bros. Lost its NBA broadcasting rights to Amazon. Its network segment, which includes traditional cable TV, has been in very steady decline, dropping 8% year-on-year. The company also applied quite pessimistic assumptions in its valuations, which were a negative 3% long-term growth rate and a 10.5% discount rate, indicating managers' low expectations for future cash flows. Moving on, let's look at this case from a broader perspective. After the pandemic, consumers' preferences moved away from traditional TV toward platforms like YouTube and TikTok. As streaming platforms became more accessible and consumer trust in traditional news declined, the appeal of cable television continued to fade. Global television ad sales dropped by 5%, and traditional media revenue is projected to decline by 3.2%. Even though Warner Bros. Streaming platforms like Max grew to 122 million subscribers and nearly doubled in ad revenue, the new income still couldn't offset the mounting losses in its legacy cable networks, which ultimately led to the goodwill write-off. This move also has its benefits and gave Warner Bros. A chance to reset. Just recently, they announced a major restructure, splitting the company into two parts, one for streaming and studios and the other for traditional network. The market responded positively to this news, and the share price rose by 16%. By recognizing the loss in one period, they reduced future drag on earnings and redirected attention to areas showing profit, like their streaming business. This helped them reframe investor expectations and focus on longer-term value.
So what advantages will the managers gain? First, the managers may apply significant amount of asset impairment to write off the assets, especially when the performance is tightly connected to the compensations and the rewards. Hence, they might just follow the accounting standard and write off the assets. Furthermore, when a company's collective performance affects an individual, the negative performance will make the situation worse. Additionally, granting the managers flexibility indicating that the managers have obtained control of the assets or part of the control. So for example, continuously writing off will let the companies take a big bath. The accounting trick to hide bad news by one-off assets impairment. This approach may prevent hostile takeover, yet the manager's flexibility cannot prevent this risk. So if the regulatory security does not work, it is possible for the managers to do such fraud. Such fraudulent conduct could bring financial benefits to the managers. So overall, managers could obtain several advantages such as meeting performance expectations, enhancing its credibility. In addition, this grant may reduce taxable income due to the poor performance of the company. Managers may appropriate the fraudulent conduct like concealing the losses from the assets if they have access to the assets.
People are starting to think that Apple TV, which is part of the Apple Inc. corporate group, might buy Warner Bros. Discovery, which owns HBO, Max Originals, CNN, and the DC Comic Universe. From an accounting point of view, AASB 3 says that this would be a business combination. Apple will use the acquisition method, which means figuring out who is buying the company, when the purchase will happen, and how much all WBO's assets and debts are worth. PPA or purchase price allocation is the same for this process. The HBO and CNN brand name, the Mac streaming platform, content libraries, and licensing rights are probably WBO's most valuable assets. Some of these will be recorded as identifiable intangible assets with definite useful life, which are amortized, while others like brand will be recorded as indefinite intangible assets and will be tested for impairment every year under AASB 136. Goodwill is any extra money that Apple gives WBD that is more than the fair value of WBD net assets. You don't have to pay this goodwill off, but you do have to check it every year to make sure it hasn't lost any value. If you see signs that it is, you should do it sooner. The streaming industry is losing viewers and money right now, according to the current trends. If this keeps up, Apple may have to write down both intangible assets and goodwill in the future, which will lower profits. Apple would also combine WBD's result with its own. This could have a big impact on a company's finances, especially if impairments happen or content doesn't do well. Finally, there's a level of strategy. Some people think that Apple could use the purchase as a chance to take a big bath, which means writing off a lot of money all at once to reset expectations and make future results look better. This raises important issues about how open things should be, how much power managers should have, and how to handle earnings. In short, the acquisition might be a good for business, but it would also make accounting a lot harder because of problems with consistency, impairment, and valuation in financial reporting.
We are now considering a situation where Apple purchases WBD in 2025 with an ongoing trend of declining viewership following it. Firstly, the continued decline would challenge the preemptive strategic expectations prior to acquisition regarding the high-quality performance of WBD's content libraries. As a result, these underperformances may indicate that expected economic benefits will not materialize, triggering the need for impairment assessments under AASB 136. Further, under the same standard, goodwill is required to be annually tested for impairments. If WBD's actual performance is short of initial projections, significant write-downs will need to occur. This accounting implication would likely reinforce concerns about Apple possibly engaging in big butt accounting. Secondly, Apple would need to consider changes on its amortization policies regarding its content libraries and other intangible assets. Given the decline in streaming, economic life of content will need to be shortened accordingly. Apple will need to review this and require the acceleration of amortization as to accurately reduce the carrying amount of its assets over the 5-year period. Furthermore, broader implications on revenue recognition must be considered. As original creations are not performing well due to declining viewership, shifts in revenue streams towards restructuring or advertising models are likely required. This works well with current trends, as advertising is said to be a promising opportunity for the media and entertainment growth industry. Specifically, this accounts for 55% over 2024 to 2028. Additionally, given that streaming subscriptions are often paid in advance, the trends faced by the streaming industry will see increases in deferred revenue. Subscribers are likely to not use a subscription in full, particularly if under a fixed-term contract, hence being a key consideration. Overall, with this acquisition, Apple will likely adopt a more conservative accounting approach with shorter-term revaluations and longer-term structural adjustments. To conclude, as streaming platforms face declining viewership, the accounting treatment of impairment and management decisions remains a key area of debate. And with that, we'll be wrapping up our presentation. On behalf of our team, Emujin, Jasmine, Zabedee, and myself, thank you for listening.